Be Wealthy and Smart, episode 1053.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about, is the rip-roaring stock market rally here or coming soon? Because today the markets were up over 2% for the S&P 500, the NASDAQ, and the Dow Jones Industrial Average, rebounding sharply from last week's sell-off. As you recall, on Friday it was quadruple witching day, which is when 4 different kinds of options and futures contracts expire. This can be a point of exhaustion for market declines, and it may just be when we see the turn from bear market decline that we've been in to a bounce back or a strong rally, what I call a rip-roaring rally, that is going to be started from the shorts having to cover their positions. Of course, we'll still have some down days, but I'm confident the stock market is about to move much higher over the next couple of months, led by covering of massive shorts by hedge funds. Hedge funds have the second largest short position ever. That's when they borrow stock, sell it because they are betting that the stock is going to go lower and they can buy it back cheaper and make the difference between what they sold it at and what they're buying it back at. If they sell it at $50 and buy it back at $10, they make that $40 profit. The amount of shares that the shorts are short right now is second only to the time period after the failure of Lehman Brothers in 2008. That means that they were not short before Lehman Brothers, they got short after Lehman Brothers failed. Because when Lehman Brothers collapsed and the stock market collapsed, they went short at that time, which was too late. They were late then, and I believe they're late again, and it's going to work against them and in our favor, causing the stock market to move to new highs by the end of July to early August, in my opinion. And recently, Zero Hedge did an article on the shorts and how they are positioned incorrectly. And they said last week's shorting by hedge funds was the second largest ever. Remember, hedge funds are basically money managers of very wealthy people's money. They basically can use any kind of maneuvering, any kind of strategy that they want to. And often they not only buy a stock long, expecting it to go up, but they also sell stocks short, expecting that they will decline in price. So Zero Hedge said, last week when we observed that Monday, the day the S&P 500 finally tumbled into a bear market, saw the 5th largest sell program in history, which was promptly surpassed by even more furious selling on Thursday, the 4th biggest selling program on record. They're referring to basically algorithms selling or automated programs that sell at certain prices and do it automatically, because a lot of what is happening in the institutional side and with hedge funds is actually program trading. They go on to say, we quoted Goldman's prime brokerage, according to which hedge funds, the so-called smart money, at least until Melvin Capital showed everyone just how dumb said money really was, not only sold U.S. stocks for a 7th straight day, Monday, but the dollar amount of selling over the last 2 sessions, Friday and Monday, exploded to levels never before seen by Goldman, which is remarkable because the bank's records go back to April 2008, which means they capture the chaos from the global financial crisis. In other words, we just saw a more frenzied liquidation than what took place in the immediate aftermath of Lehman Brothers collapsing. Now that is very significant because we all know in 2008 there was a global financial crisis. It goes on to say the data also prompted us to question how much of this was actual normal selling, i.e. closing out existing positions, versus short selling or betting on more downside. We now have the answer, according to Friday's post-mortem note by Goldman trader John Flood. So basically what he said was it was the second largest ever on our record, second only to the week ending June 12th of 2008. And the article goes on to say, and predictably, following such massive shorting episodes, what follows traditionally has been a major squeeze. As Goldman's table below shows, returns following 20% S&P 500 declines have typically been positive. And this chart shows that from peak to trough, when there's been a 20% decline, we can go all the way back to 1962, 1966, 1970, 73, 81, 87, 1990, 2001, 2008, 2018, and 2020. The peak to trough decline in the market has been anywhere from 20% to 57% during those dates. But the returns following that, 12 months later, have been 26% higher, 25% higher, 12% higher. In 1973, it was 29% lower. 1981, 9% higher. 1987, 23% higher. 1990, 29% higher. 2001, 1% lower. In 2008, the big financial crisis, 30% lower. In 2018, 37% higher, and in 2020, 59% higher, for an average return of 15% higher 12 months after the bear market. And the median, meaning half are greater and half are less, was 23% higher 12 months later. So the overwhelming evidence is that a year from now, markets will likely be double digits higher, on average 15% higher. And what zero hedge means by a squeeze is when the shorts have to buy back stock to cover their position and close it out. You see, they've borrowed stock, sold it, and now they have to buy it back. And if they can't buy it back lower and make a profit, they have unlimited losses on the upside. So if they bought it, sold it at 40, hoping to cover at 10, but it didn't go down to 10, it went higher instead. It went up to 50, and then it went up to 60. Now they're losing $10 a share, $20 a share, and they have to buy it at any price to close the position out, to return the shares that they borrowed. And this is what a short squeeze is. It's having to pay any price for the shares because they've gone in the wrong direction. They're losing money because the stock went up instead of down. And now that we may have turned the corner on the bear market this year, if we're getting a major bounce now, or starting a new bull market, or going on to new highs, or all of the above, the shares may start rising and causing the shorts to have to buy them at any price to close their position. And that's called a short squeeze because the price can go higher and higher and higher as the shares are limited and as they're hard to get, and everyone who is short is scrambling to buy those shares to close that position out and stop their losses. That's a short squeeze. And that is something I think is in our future, and that's what this article was saying is in our future. In fact, the title of the article was actually, quote, "Nasty Squeeze on Deck. Last week's shorting by hedge funds was the second largest ever." So I know that was a little more involved and technical than I usually like to talk about on the podcast, but I felt it was necessary to explain why I think we are going to have this rip-roaring bull market in our near future, and how it's going to start by the shorts having to buy shares and cover, and why we're going to see some pretty amazing increases in the value of certain stocks and indexes. So just like the shorts went short too late after the Lehman crisis, they're late again, and it works against them and in our favor. At times like these, we are reminded of the words by Charlie Munger, who is Warren Buffett's partner. He said, "The big money is not in the buying and the selling, but in the waiting." That's certainly true with us holding through this bear market, waiting for it to rebound, which I think the time is now, waiting for cryptocurrencies. We're already starting to see a strong rebound in certain cryptocurrencies as well. So our patience with holding, I think, is about to pay off. If short selling is something you want to know more about, I recommend you listen to podcast number 859, How Archegos Capital Wiped Out Billions of Dollars. There I explained what happens when short sellers fail, and it's a very interesting story if you aren't familiar with it. This is the year that many hedge funds have actually gone under, and we may see more of that. You see, during the pandemic, it was easy to bet that companies' shares might go to zero or they might go out of business. We saw many companies go out of business. We saw some companies go close to going out of business, companies like AMC movie theaters and GameStop. But they were able to recover. But there are some hedge funds that are still short those shares, and they've already reversed and started to go higher. These companies, plus many others that have high short interest, are probably about to reverse, and those hedge funds are about to lose a lot of money. So we'll be following this story and reporting back to you with updates along the way. If you haven't subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available. And don't forget, all of my podcasts and the whole Wealth Mentoring library is on my website at lindapjones.com/podcasts. And there's a search box there where you can enter in keywords of anything that you want to know more about. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.